Hello and welcome to Week 5, Taxation of Capital Assets. By the end of this lesson, students should be able to identify assets classified as capital assets for income tax purposes, understand the complexities of related party transactions, identify the tax consequences of gain or loss on sale of assets and residence, and holding period requirements, and describe the tax ramifications of related party sales, wash sales, and Section 1244 stock sales. So as we learned in a previous lesson, capital assets are defined in the tax code by what they are not. Capital assets are non-business, non-ordinary income assets. And capital gain property is tax advantageous because long-term capital gains rates are generally speaking lower than ordinary income tax rates. Now before we start talking about taxable gains, we need to back up and distinguish between a realized gain and a recognized gain. So a realized gain occurs when assets are disposed of, typically when they're sold or exchanged. And this could be considered the economic gain or loss. So how was the taxpayer's net worth affected by the disposition of the asset? Perhaps it went down, it was a loss, perhaps it increased, it was a gain. In contrast, the recognized gain is synonymous with the taxable gain, and realized and recognized gains as a general rule will be the same. However, there are specific provisions in the tax code that make some realized gains different from recognized gains. Sometimes the realized gain is excluded altogether, sometimes it's deferred, and sometimes it's just reduced. Now once we've determined that a capital gain does exist and it is taxable, it's a recognized as well as realized capital gain, then we need to determine at what rate that gain will be taxed. And you can see here there are several different rates to choose from. So a short-term gain is actually taxed at an ordinary income tax rate, so there's really no preferential treatment for the short-term capital gain. In contrast, long-term capital gains can be taxed as low as 0%, or they could be taxed at 15 or 20%, and that depends on the taxpayer's marginal income tax rate, or in other words, the amount of other income the taxpayer is recognizing in that year. Section 1250 property, which we'll talk about in a little bit, in the next lesson actually, is taxed at 25%, and collectibles are taxed at a 28% capital gain rate. So how does one qualify for long-term capital gain treatment? Generally it's based on the holding period. Usually you must hold the property for at least 12 months in order to gain long-term capital gain treatment. However, there are a few exceptions. They include involuntary conversions, donated property that is contributed to a charity, or property acquired by death. And as we've learned in a previous lesson, property acquired from a decedent automatically has long-term capital gain treatment. So you receive property as an inheritance one day, you sell it the next day, it is still long-term capital gain property in your hand, and long-term capital gain treatment applies. So we talk about these preferential capital gain treatments, and those preferential rates are available for most taxpayers, for the unincorporated taxpayer, and more precisely it's for the non-C corporation taxpayer. So even an S corporation, technically they are incorporated, but those gains and losses are not taxed at the corporate level, they flow through. Same with partnerships and LLCs, sole proprietorships, and certainly any gains that are generated by an individual. All of these long-term capital gains qualify for that preferential treatment. Now that's on the gain side. So what about losses? Losses have a slightly preferential treatment, but not as good as the preferential capital gain rate treatment. So capital losses can offset capital gains in an unlimited amount. So you have $1 million of capital gain, $1 million of capital loss, you offset the two, and you have zero net capital gain income. However, what happens if you have a large capital loss and you don't have capital gains to offset that? Well, you can offset ordinary income in a year up to $3,000. So let's say you have a $30,000 long-term capital loss for the year. You don't have any other capital gains. You can offset ordinary income, $3,000 of ordinary income, and then the rest of the capital gain must carry forward. So you can look at it two ways. If you had a very large capital loss, say in 2008, 2009, of $100,000, $200,000, you may think it's very unfair that you don't get to deduct those losses in the current year, in 2008 or 2009 when they occurred. However, if you are a taxpayer that doesn't have a capital loss carry forward, maybe is looking to shave a few dollars off of this year's tax bill, being able to harvest $3,000 of losses and use that against your ordinary income tax for the year, that looks like a pretty good deal. So it's all in the eyes of the beholder. Again, corporate taxpayers, C corporation taxpayers are taxed differently with respect to capital gains. So basically there is no preferential tax rate for the gain, and you are not allowed to offset any losses against other income. So the corporate taxpayer has a little bit different treatment for capital gains. Now we have a few other capital transactions that I'd like to cover before we close the lesson. They include the related party transaction, the sale of a personal residence, wash sales, and Section 1244 stocks. So see, these are some of the transactions that are specifically identified in the tax code where realized gain and recognized gain are not the same thing. So let's take a look in more detail. Sales to related party. As the name suggests, if you sell something to a relative at a loss, that loss will be disallowed. Now, it's not just a human relative. It could be the corporation owned by a relative. And related party has different definitions depending on the provision that you're applying related party status to. So be sure you take a look at your textbook to determine who exactly is a related party in terms of people. But also remember that the closely held corporations, the LLCs, the partnerships, the brother-sister corporations, any of those entities that your relatives own or that you own, those are considered related parties too. And so those losses are deferred until the property leaves the family unit. So I sell a house to my brother at a loss. He sells the house to his daughter at a loss. We neither of us can recognize our losses. Now my niece eventually sells a property to someone outside the family, to an unrelated entity. Doesn't matter whether it's a gain or a loss. At the time that property leaves the family, then I can recognize my loss, and so can my brother. And so the purpose of related party loss rules, disallowance rules, is it's very easy for mother and son, or brother and sister, or cousins to generate some non-economic losses simply by selling to related parties, and related parties are more likely to help each other out and to collude, and so that's what the related party provisions are trying to avoid or to eliminate. So now we'll talk about the exclusion of gain on the sale of a personal residence. So it's pretty simple. If you are a single individual and you sell your home, you can exclude up to $250,000 of gain. For a married couple, it's twice that, $500,000. All you have to do is live in that house, use it as your personal residence for 2 out of the last 5 years, and that gain is completely tax-free. There's no deferral, there's no keeping track of it, there's no need to buy another home. You generate the gain, you realize the gain, but you never have to recognize it as long as you meet the residence requirements. So we'll talk about wash sales in just a second, but I want to revisit for a minute how basis is determined when you sell a stock or a security. There are several ways that you can track basis. You can use the first in, first out method. You could use the last in, first out method. You could use average cost method, which is very popular with mutual funds, or you could use the specific ID method or specific lot method. Any of these methods are permissible with the IRS. So now let's talk about wash sales. If you sell a security and within 30 days of selling that security at a loss, you repurchase the security, that loss is disallowed. Now, it must be the exact same security in order to trigger the wash sale rules. So for instance, if you buy the Vanguard 500 Index Mutual Fund or ETF, you sell it, and then the next day you buy the Barclays equivalent S&P 500 Mutual Fund Index or ETF. Those technically are different funds, even though they're substantially the same security. They are different funds, they have different ticker symbols, and so you will not run afoul of the wash sale rules. However, if you sell Microsoft at a loss and you buy it back the next day or in 15 days, that loss is disallowed. Now note that this only applies to losses. Congress is happy for you to recognize gains all day long, and so you don't have to worry about the wash sale rules in terms of gains. The last provision we'll talk about is Section 1244 stock. Section 1244, of course, is the code section that applies to this provision. Section 1244 stock is small business stock in a C corporation. If you invest in this type of corporation and you end up selling that stock at a loss, rather than having capital loss treatment, and remember that would mean that you would be limited to $3,000 of losses offsetting other income per year, you actually get ordinary loss treatment for up to $50,000 of losses if you're an individual, or $100,000 for a married filing joint couple. This is a provision. Congress wanted to encourage entrepreneurship, and so if I am starting a small business and I organize as a C corporation, you are more likely to take the risk of investing in my startup business if you know that the potential losses are ordinary versus capital gain or capital loss. So in summary, long-term capital gains receive a preferred tax rate. Capital losses may offset up to $3,000 of ordinary income per year, and generally realized gains equal recognized gains unless specifically addressed by statute. We've talked about some of those specific exceptions in this lesson, and we'll learn about additional exceptions in later lessons. I hope now you have a better understanding of capital gain and losses.